Hey, what's up, everybody? It's Ken back again today on the No Money Real Estate Podcast. I'm going to prove to you that it doesn't matter what type of real estate investing you're doing. If you master the 4 steps, the 4 elements to successful real estate investing, you can do anything. I'm in Barbados right now. And for the last 3 days, I've been looking at a major hotel in the main capital city of Barbados that I think we're gonna buy because it fits the 4 steps. And I'll get into it right after this.
Hey, my name's Ken Dunn, and I'm a real estate investor. I wanna welcome you to the No Money Real Estate Podcast. On this show, I'm gonna interview elite level real estate investors from all over North America. And I'm going to help you to see one thing that all successful real estate investors have in common. They built their portfolios without using a dime of their own money. I've got a portfolio of $300 million in real estate. That includes resorts, apartment buildings, commercial buildings, and I built the entire portfolio without using a dime of my own money. Real estate is a business that anybody can get into, but the strategies that those tight real estate investors use to build massive portfolios have been kept secret for decades. Now, because of this show, I'm going to reveal them to you. So let's get started.
If you're listening to the podcast at all, sorry, I actually just got given this really yummy local delicacy. It's called a raspberry pop. The only ingredient is raspberry, and it's a popsicle, I guess. So I'm breaking the rule. I'm doing a podcast show while eating a popsicle, but it doesn't matter because there's a really valid point that I want to talk to you about today, and that is the 4 major steps that I'm always talking about. And I have yet to have somebody challenge me on this or prove me wrong. But my theory or philosophy is that if you're doing real estate investing and you really want to build a massive real estate portfolio, or if you just want to make some supplemental income for your family, you just have to master 4 steps. And here's the 4 steps. Number 1, you have to be able to identify undervalued properties. So you have to be able to look at a property and say, for whatever reason it is, this property is a good deal and I'm getting it undervalued. Number 2, you have to understand that when you're financing real estate purchases, you finance in 2 stages. You finance to acquire the property. Normally, a lot of that acquisition-based financing is done with private investors' money. And then the second phase of financing is stabilization financing. In other words, you buy the property, you increase the value, then you refinance and stabilize it. That is if it's a property that you're keeping. Now, that's what we're talking about today, buy and hold, real estate, obviously. And then once you acquire the property, you got to increase the value significantly. But understanding how to increase the value of property is part of identifying the hidden gems. And then the last thing is the exit from phase 1. So once you buy a property, you increase the value of it. If you do succeed in increasing the value of it, then you can refinance it, keep the property, and get into more stabilized financing. Your acquisition financing is going to be expensive. It's mostly private. So you don't want to stay in that for a long time. You want to stay in it long enough to increase the value of the property and stabilize that property at that new value, and then refinance it. Oh my God, this is dripping all over me. So, what am I doing down in Barbados? I have to be careful because I don't want to breach a non-disclosure agreement, but I can tell you that for the last 3 days, I've been looking at a hotel here in Barbados that the owner's interested in selling, and we're looking at it off market because of our contacts. Well, it's not our contacts. It's really because of my business partners, Michelle and Anatoly, who I'm down here with, that found this property. And they brought it to me because, I'm in hospitality. I understand hospitality. So when we started talking to the owner of this property, and just to give you a little context, it's not really a beach resort, but it's an incredibly unique boutique hotel across the street from the beach. We're in Barbados. Take a look around here. Everything is either on the beach or across the street from the beach. But it's a small hotel. It's got 50 rooms. It's got great occupancy. The owner wants a significant amount of money, millions of dollars, but not quite 10 million. And when I started talking to Michelle and Anatoly about this property, I mentioned to them that I'm not interested in buying it unless I know I'm getting a good deal on it, unless I know I'm getting it undervalued. Now, when you're talking about a hotel, you have to think about it the same way you would a business. When you're assessing the value of a hotel, you assess it on 2 principles or 2 parts. Firstly, you assess it on the actual physical property that you're buying. What kind of state is that physical property in? Does it need to be renovated? Does it need new windows? Does it have sufficient heating and air conditioning systems for what you're doing? Is it structurally sound? Then the other side is the business, because the value of a hotel is going to be based on the revenue that the business is making and the net profit that the business is making and the real estate. And there's a whole bunch of metrics that go into this, but here's a couple principles that if anybody's ever interested in getting into hotels or resorts, here's a couple of things that you want to really understand. A properly ran hotel business or resort business should run at somewhere between 40 and 50% NOI, net operating income, profit, which means it should have a very healthy EBITDA. EBITDA, for people that don't know, search it. It's EBITDA, earnings before interest, tax, and depreciation. When you look at, so here's the interesting thing. When we talked to the owner, and I wasn't tipping my cards to him or anything, but just, to kind of think through the process to see if there was really an opportunity to increase value, because the place had just been recently renovated. So if I was going to be truly buying something at a discount, then it's going to be based on how the business is run and can I increase how the business is run. In other words, what got my interest is that when we asked him what net operating income are they getting right now, and he said right now about 15%. And he was happy with that because he's a traditional business owner. And he's got other hotels on property that he said have higher and better net operating income, but this one is what it is and he's not worried about it because it makes money. I know that if that's what he's running at now, and I can take 15% and turn it into 40% net operating income by increasing the revenue and reducing the expenses, which I happen to have a little bit of an expertise in, then I can increase the value. Well, this is one of the first podcast episodes that I actually had to film in 2 parts. It was 35 degrees out there, and right in the middle of a sentence, the camera shut down, and I had to come and cool it down a little bit and jump back on here with you. Anyway, I was talking about the net operating income in that business. And like I was saying, the owner told us in good faith that it was operating at about 15%, which is nothing to be shabby about. Like, the hotel's been around for 40 years and it's operating consistently at 15% every year. That's a good thing. But remember, we're talking about here buying something undervalued and seeing how you can improve it. So when I looked at the property, it was very clear to see that there was no way I was going to increase the property's value by renovations. It's all been completely renovated and it's really cool. It's a really chic place. And so when we were going through this place, I was telling my partner, Michelle, and Anatoly, that I didn't know if this would even work because it was so newly renovated. And I just assumed that they'd be in that 40th percentile in terms of NOI. So when he told me that the property is only operating at 15% net operating income, I got excited, or I got intrigued. And what I did right away, because I have such an amazing team, I went to my director of hospitality back in Canada and I had him to start doing some research on this specific property to see if he could identify any areas of improvement just based on what he saw on the OTAs. But OTAs are all the places where people book accommodations now, like Expedia, Booking.com, Google, Apple, travel agents. They're all called OTAs. And so a lot of money can be lost if you don't structure your relationships with the OTAs properly. You can lose a lot of money. And I'll give you an example. If you're not good at negotiating, Expedia and Bookings.com will charge you 25% of the booking that you have to pay them. You're selling your room for the night for $500 and you lose 25% of that right off the top. That's your net operating income gone to shit. If you're really smart, you know what you're doing, you can negotiate with those OTAs and drop that down to about 15%. So that's an extra 10%. That would take your 15% that you're currently making and turn it into 25%. So it would be on the right track. So we started looking into that relationship with the OTAs and how that was working. We were trying to determine how much of the bookings were actually happening through the company's, the hotel's website, as opposed to the OTAs. So if you think about that for a second, if I'm booking hotel stays and I'm getting hotel stays booked through my website, I get to keep 100% of the money. Even if I've negotiated a great deal with the OTAs and I'm paying them 15%, well, that's still 15% I have to get away. So this hotel is operating at 20% direct bookings, 80% through the OTA, which that got me really excited because I know my team and I know exactly how to change that to turn it into 40 or 50% booked through the website as opposed to the OTAs. So if we do those two things, if we change the relationship with the OTA by 10%, and we get more bookings through our website, not do anything else. Now we saw some other things there too that really would increase the revenue of the property. Another thing we saw is the restaurant. It didn't really look like there was a big focus on doing something significant with the restaurant. So anyway, all these things, you hear me talking a lot in this podcast and in life about increasing the value of the properties. And I don't really get a chance to talk a lot about when you're looking at a real estate asset that has a business with it, where you're making money with that business at the same time, then you can easily increase the value just by increasing the revenue in the business and the profit in the business. The rule of thumb in Canada, at the beginning of this podcast episode, I was about to mention this, then I changed the topic, and I bet you were wondering if I was going to come back to this, but the rule of thumb in Canada is that for every $100,000 in net income that you increase the business by, the value of the business, and this is in hospitality specifically, goes up by $1 million. So if I can make those changes and I can go from 15% to 40%, I'm going to increase the value, the net operating income, by about $500,000 a year. So that means I'm increasing the value of the building, the hotel, the business by about $5 million. So I'm going to increase the value of the business by that much. Now, the interesting thing is, when I look at what the owner is wanting to sell this property for, his value, if you look at it from the outside, you might think he's asking too much for it. But when you think about what that value actually is based on the revenues of the business and the real estate, then he's probably not asking too much for it. And then on the other side of that coin, if I'm confident I can come in there and in the short term, I can increase the business by that much. So the core things we talked about were moving more of the bookings from the OTAs to the hotel's website. So the hotel books them themselves. And at the same time of that, renegotiating the agreement with the OTAs to go from 25% to 20 or 15%, which is where it should be. And then putting a new focus on the restaurant and ancillary revenue that's occurring there. We could effectively increase the net profit significantly and increase the value of the property significantly. So if you think about it, when I'm talking about a flip, I normally talk about, hey, find something crazy undervalue, rip it apart, rebuild it, and increase the value significantly. When that's what you do in a simple project. If you're doing an apartment building, as an example, you're gonna buy a dilapidated old apartment building, so you're buying it undervalue, you're gonna renovate the whole apartment building, and you increase the rents. So that's the same idea as a hotel, where we're increasing the revenue in the business. In an apartment building, you're increasing the revenue in your business. And that's how you increase the values. And we do the exact same thing here. What makes this hotel space maybe a little bit more unique is that I really have an expertise in the space. And not just that I have it, I have a team of people, the executives of our company, that are all from the hotel industry and have a significant expertise in that space. So what I found really interesting, and why I wanted to have this conversation with you, is here I am in Barbados, one of the most beautiful islands in the Caribbean. And I'm down here looking at a hotel, and it's the exact same business fundamentals, the exact same 4 steps, the exact same ideas and things I'm looking for in the acquisition of real estate that I would use in Toronto or use in Canada. And it holds true, which is proof. And that's why we started this. It's proof that if you want to master real estate investing, if you want to make a lot of money in real estate, just master these 4 steps. Go out and find properties undervalued. Whatever space you're in, make sure you know how value is created in the space. Acquire properties undervalued. Acquire properties with innovative financing solutions. And there's lots of innovative financing solutions you can use in acquisition. You can use vendor takebacks. You can sell equity, so you can sell a piece of what you're doing to get the money you need. You can use private financing. One of the things I really try to do, private financing is very expensive. You're talking 15% interest rate. But what if I can take, let's say I needed to come up with $7 million. What if I could take, instead of $7 million at 15%, what if I could get $3 million of it by selling 20% of the property? So a whole bunch of people get to share in the profits with me, but now I only need to finance $4 million. And then what if I could get the vendor, the person selling the property, it's called a vendor takeback. What that actually means is the vendor is going to loan you a part of the money. So instead of you giving him the money, part of it turns into a loan at a nominal interest rate. And somebody who's selling a major asset, they love to do things like that because it defers taxes. So if he were to sell that property to me all this year, he would have to pay tax on $7 million. But if he did a vendor takeback, in other words, turned $4 million of it into a loan, he would only have to pay tax on $3 million this year, which would be the lower tax rate. And then he could, after 2 years, take another $2 million and let me keep borrowing $2 million, pay a lower tax rate, and then $2 million 2 years after that. So we do all kinds of innovative financing, and there's all kinds of really unique ways to finance properties. And of course, when it comes to financing properties and borrowing money and raising capital, you cannot underestimate or undervalue how important it is for you to build a reputation and an expertise in this area and find a way to show the world that expertise and in enough detail that they can start to build trust in you. People ask me all the time, how can you go out there and keep raising millions of dollars and people trust you with millions of dollars? It's because I do this. It's because I'm constantly creating content and sharing it with everybody so that they can truly see that I know what the hell what I'm talking about. And you should do that too. Anyway, and I've had a couple conversations. The person I'm talking to about this apartment or this hotel, I've had some of these deep conversations with him, and I could see that he was building trust in me just because he knew that I knew. Anyway, I hope you guys have enjoyed this little conversation, but I hope you appreciated it. If you have any questions about what we've talked about today, go into the notes of this show and make sure you ask about them. And do not forget to subscribe to the podcast or subscribe to the YouTube channel if you prefer watching the videos. There's lots of great content like this. What you're gonna find is I am running 8 businesses right now. Sounds like a 9th is coming soon. And I'm constantly transparent. I'm very transparent about how I'm running it and the things I'm going through and the things I'm learning, because I wanna help as many people as humanly possible at the same time.